This 2 year since the Fed last met has been all over the place. What do you make of it?
It is really unprecedented, the kind of moves we've been seeing. I think we do have to ask the question how much positioning could be impacting the 2 year as well. We have seen record short positioning in some of the futures data, which could be adding to some of this volatility. But the 2 year really is a reflection of how much risk this market wants to take. With the 2 year moving sharply lower, that's typically consistent with the bond market betting that the Fed is going to have to engage in very rapid interest rate cuts, simply because there is economic weakness on the horizon. So if we see the 2 year continue to break down, it really would raise the question of how much equity or risk asset resilience we could continue to see if we are going to see much more economic weakness.
There are people who want to play the recovery off the back of a rate cutting cycle. They want to play the recovery before we see the recession. Cameron, BlackRock came out with this. They say we stay underweight equities, downgrade credit, prefer short-term government bonds. We don't see central banks coming to the rescue with rate cuts, but using other tools to ensure financial stability. The Fed is going to hike this week. Now, Cameron, a few months ago, a lot of people said the same thing. The Feds are not going to save you. It's not going to save you. And here we are, a few bumps in the road, a couple of bank failures later, and all of a sudden it's rate cuts. The bank's going to save, the Federal Reserve's going to save you. Get long the NASDAQ. What do you say back to them?
Well, the Fed has a huge inflation-sized pickle in this, which is that every other time that they have come in to support financial markets, the reality has been is that inflation has been at or below their target, meaning it's below 2% on the core PCE, and that's simply not the case anymore. So we've talked a lot about how the Fed doesn't want to be Arthur Burns with that stop-go policy of cutting rates and hiking rates, and that really cemented inflation of the 70s. But we also have to ask the question, does the Fed not want to be Alan Greenspan? Do they not want to cut rates by 100 basis points like they did in 1998 in the face of LTCM and effectively create an asset bubble which could exacerbate inflation in our current environment? So we think that it's far more of a tough decision of a catch-22 than at any other time really since the early 90s.